Good morning and welcome to this morning's webinar, The 8 Elements of Extended Care Riders, Finding the Right Fit for Each Client. My name is Brian Leising. I'm your host, and this is being put on by Financial Brokerage. And for those of you who are not familiar with Financial Brokerage, we're a national marketing organization working primarily with independent insurance producers and registered reps all across the country in the areas of life insurance, annuities, long-term care, critical illness, disability insurance, and Medicare supplements. I've been with the company about 15 years now after spending some time in personal sales out in the field like most of you. This morning we're going to discuss extended care riders, which really encompasses both long-term care and chronic illness riders on life insurance policies. And the webinar should last about 25 minutes, depending upon questions at the end. So we'll get into it here. The reason we're discussing this is that life insurance policies that have some sort of a long-term care element included in it, the riders really are not all created equally. Different combinations are going to appeal to different clients more than others. And this morning we're going to review what I have identified as the 8 distinguishing features of all these riders offered on life insurance contracts. Now, every one that you see, every product out there, is going to have some combination of each of these 8 elements. And once you know what they are and how they work, you're going to be armed to be able to find the right formula for each one of your clients out there. Now, why is this important? Why are we even talking about this? Well, the high cost of extended care or long-term care is really the greatest financial threat your clients are going to face during their retirement years. If you think about it, people spend a lot of time building up their retirement income. They want to have enough money to live on comfortably throughout those years, and we focus on growing that money. And we can do things with asset allocation and dollar cost averaging and all that to try to mitigate losses or minimize them while still gaining enough money to live on. But you know what? The stock market is going to go up and down. When it goes down, it goes back up. But what if our clients have a huge expense coming out of that retirement fund, and it's one that they're not going to be able to recoup? That's the high cost of long-term care. And numbers listed here are about 4 years old, so assume them to be much higher. But 4 years ago, the annual median rate for skilled nursing in a 24-hour facility was $81,000. It wouldn't surprise me if that was $100,000 today. The cost for assisted living or a 40-hour work week of home health care was about half as much. So again, I would imagine about $50,000 a year today. And that home health care cost, that's 5 days a week, 8 hours a day. That means a family member is stepping in for most of the day, most of the evening, and on weekends. So if a person wants round-the-clock care, you're going to pay a lot more than that. So think about it. At 50 grand a year or 100 grand a year, how long is your client's money going to last? What if they get Alzheimer's and they need care for 20 years? The money isn't going to be around too long. So it's a huge expense, a huge drain on retirement assets. Now, there are some ways to take care of that. And in the past, we've used traditional long-term care insurance, and that is still around. That's a very viable option, and it's still a great fit for a lot of people. I have a policy myself. However, we've seen over the last decade or more, sales of traditional long-term care have been going down. Premiums have been increasing on newly offered products and also on existing policies. Since these are filed as health insurance products, companies can raise the rates on your clients' policies. And because of all that, we've seen a lot of carriers exit the market, which just makes the problem that much worse for those that are still in it. So what can we do? Well, on the flip side, we've seen sales of linked benefit plans or life insurance-based LTC solutions go in the opposite direction. They've been increasing like gangbusters. In fact, if you look at the chart here, back in 2006, we didn't even see $500,000 in linked benefit sales. And last year I have numbers for 2013. They were up to $2.6 billion. This marketplace is growing tremendously whether we're looking at single premium or monthly payment type of policies. There's a lot of folks that really like this this model as the way to get their extended care coverage. And why is that? Well, when I have conversations with folks who have sold these, it all boils down to two very important guarantees. One is the guarantee that the premium will never change. These are based on whole life products or no lapse guarantee ULs, and there is never a chance that premium is going to go up on the client, unless the client themselves screws it up and doesn't pay a premium somewhere along the way. But the company will never ask for a rate increase if the client does what they're expected to do. The other important guarantee, probably more important, the fact that a benefit is going to be paid out no matter what. One of the biggest objections to traditional long-term care policies is a client will say, well, what if I die in my sleep, I die in a car accident, and I never need to use this policy? I'm afraid that I've wasted my money. I could have spent it. I could have used it to live on, take a vacation. I could have passed it on to my children, my grandchildren. I feel like I'm wasting my money. Well, they don't have to worry about that with a life insurance-based solution. If they don't use it for LTC purposes, the money is going to pass to their heirs. So you have a 100% guarantee that something will be paid out. That is huge with folks. Now, since we've seen a huge increase in these products, it seems like just about every company we work with here at Financial Brokerage offers one of these riders. But every company seems to have their own version of them. And the problem is that they're really not all the same. They share some common features, but no two companies offer the exact same combination of benefits. So how can you choose which one is really right for your client? Well, that's what we're going to help you with here this morning. We're going to explore those 8 elements that I mentioned earlier of the extended care riders. So you're going to come away with a great understanding of exactly what's available to your clients today. So let's go in here with the first element, payment frequency. And this is probably the first major distinguishing feature among these products. You have a choice to make as far as what you offer to your client regarding how they pay the premiums for the product. The original linked benefit plans on the marketplace, which came out around the year 2000, let's say, were single premium products. They were meant to be wealth transfer policies that a person could tap into for LTC purposes. Now, these appeal to self-insurers. You have a client that's got $100,000 or $500,000 sitting around, and when you ask them the purpose of those funds, it boils down to they're saving that money back in case they need it to pay for long-term care services somewhere along the way. Now, the national average premium going into these single pay products is $75,000, and I'll tell you, if your client doesn't have at least $50,000 to put into one of these, we definitely need to look at the continuous pay model, because they're not going to get much leverage on those dollars if it's under $50,000, and in some cases it would be impossible to run. So I think you really want to target $100K or more. If they have that set aside, that's going to cover 1 year of care. So we can oftentimes get them about 6 years of care, or turn that $100K into a $600,000 pool that they can use for LTC purposes, and roughly a $200,000 death benefit. That's how the numbers typically will work out. You'll double the lump sum for a death benefit and get about 6 times that amount in long-term care. This represents about 25% of the marketplace, according to LIMRA. So there are some clients that have that money, and this is a great fit. However, most of the sales you're going to see in this marketplace are of the continuous pay model. These are ULs. These are whole life products. Obviously appeals to a much broader population base, since it makes up about 75% of the policies sold. And nearly every insurance company out there now has some form of extended care rider available on their products. And there are some differences among them, which is the whole purpose of this webinar this morning. Now, I mentioned earlier that one of the keys to these products, one of the key appeals, is the fact that the premium will never change. Now, that's almost 100% true. There are some products out there that are not built on a no-lapse guarantee chassis, or they're not on a whole life chassis, and that's what I would call element number 2. We don't see a whole lot of business with those because one of the primary reasons people buy these is the fact that their premium will never change. However, you need to be aware that some companies have these riders available on current assumption ULs. They're usually index ULs, and if these are funded properly, meaning they're overfunded or they're maximum funded, your client shouldn't have any problem with that policy ever lapsing. But again, these are usually primarily sold for the cash build-up purposes, whether it's for college planning or retirement, and the LTC element is sort of an added benefit put in there. If your client doesn't care so much for the guarantees and you need to meet multiple needs with one product, that might be a place to go. But most of them that we see sold have this no-lapse guarantee provision. And all that means, if you're not familiar with it, is that as long as your client pays the premiums on time every time, they take no loans, no withdrawals. It doesn't matter if they have cash value in the policy. The policy will always remain in force. It can run on zero cash from day one. Not a big deal. All right, let's move on to our third element, waiver of premium. This is something that is really just expected on traditional long-term care policies. In fact, once you qualify for your benefits, you're not going to have to pay the premiums for your policy any longer. And for the most part, that's true of the life insurance-based policies too, but there are some nuanced differences to be aware of. Transamerica, for one, they only, once you go on claim, they waive the extra premium you're paying for the LTC rider, but not the premiums for the base life insurance policy. Now, if a client's receiving a benefit, you know, they're getting some extra money because of that. Maybe they could use those dollars to pay the premium, or if they could just continue to pay the premiums out of whatever funds they had been using all along. So maybe it's not a big deal, but you need to be aware of that. Some companies out there require the premium payments to continue, you know, no matter what. They're not going to waive anything. American National, one of MetLife's riders, and then Mutual of Omaha. Again, maybe not the most important of the elements we're going to talk about this morning, but you need to be aware of that. All right, the fourth element, and this is probably the most important one to be aware of here, and it involves the tax code that the companies use, or that they file these riders with the states under. And the benefit qualifications really go hand in hand with that tax code. So give you an overview of that. There are two tax codes that companies can use when they file these riders with the various state departments of insurance. One is 7702T. These are the only riders that can be marketed as long-term care riders. That's why you see me use the word extended care riders. I try to use that to encompass both the LTC and the chronic illness in one phrase. Now, because this is a true long-term care rider, you are required to have your state's long-term care continuing education credits up to date. You are also required to have a health insurance license. Most folks will get a combined life and health license, but some people have just a life license. And if that's the case, you need to get that health component to be able to sell this. Now, one benefit of these true LTC riders, it allows the companies to offer what they usually refer to as an extension of benefits. So your base policies are usually what's accelerated. So you have a $500,000 death benefit. You could roughly say that the client can use that money, that whole $500K, for long-term care purposes, or it passes as a death benefit, whatever they don't use for LTC. Well, if it's a true LTC rider, then the company has the option of giving a client additional LTC benefits above and beyond that death benefit. And we usually see those on those single pay products where I mentioned earlier a death benefit might be $200K, but yet they have $600,000 available for LTC. So you'll only see that on the true LTC riders. Now, the big difference here would be in the benefit qualification. To qualify for benefits on a true LTC rider, all your client needs to do is lose the ability to perform 2 of 6 activities of daily living, or have severe cognitive impairments such as Alzheimer's or dementia, and you know, that's it. There's no other restrictions. Once they qualify, they qualify. So you know, a little easier on the client that way. Now, the 101G tax code. That's the other code companies will use, and those riders cannot use the words long-term care in their description. So you'll see chronic illness, you'll see accelerated benefit for whatever. You usually see longer names for those riders. Because of the way it's filed, you don't need to have your state's specific long-term care continuing ed credits. With these products, the amount accelerated is limited to just the death benefit itself. They can't offer anything extra. They would have to file the rider differently to do that. And then our big difference here is in the qualification. If you have a chronic illness rider, you start out with the same qualifications as the true LTC rider, but there's one additional qualification, and that's the fact that your client's condition has to be deemed to be permanent. They are not expected to recover. So if your client goes in for, I don't know, maybe double hip replacement, and they're going to be out of it for several months, if they had a true LTC rider, that would pay. If they had this chronic illness rider, it would not pay. Now, I don't know in reality how often that situation is going to come up. We had some numbers from Genworth Life when they looked at their own book of claims, and they said that 70% of their LTC claimants never got better, but 30% of them did recover and were able to go off claim. So now you're looking at 70-30. Another carrier brought us some numbers, I think from LIMRA or another source, and they said the numbers were more like 90-10. 90% of the people never get better, and 10% do. So, maybe you want to sell more of the LTC riders than the chronic illness for that purpose, or at least make your clients aware of that feature so they're not thinking that they're going to receive a benefit when maybe they aren't. Now, the chronic illness riders tend to cost a little bit less than the true LTC riders, so you have to take that in consideration too. What I've found with these riders is that you definitely get what you pay for. If you're willing to pay a higher premium, you can get a lot more bells and whistles and a higher quality rider on your life policy. If you're really pinched for money and trying to stretch those dollars, there's going to be more restrictions on how you can access that money. Now, we don't have a whole lot of companies that offer the true LTC riders. You'll see them listed here, Lincoln Financial and One America. They do a great job with the single premium products. AXA and Transamerica have true LTC riders available on their IULs. What they're lacking, though, would be a no-lapse guarantee provision. So you can't always get everything you want. Most of the insurance companies we work with here by far use that 101G model, the chronic illness rider. That's what Lincoln Financial uses on their multi-pay product, their UL, and that's usually what you'll see in the marketplace. All right, moving on to our fifth element, the elimination period. This is the time in which your client self-insures, and it's typically going to be 90 days. So they qualify for benefits, they've lost their activities of daily living, and now they think they should have some money. Well, no, they actually have to pay the first 90 days out of their own pocket. And we see that on disability policies and on traditional LTC policies. If you've sold those, you see this all the time. Now, there are some exceptions. State Life has the elimination period set at 30 days for home health care and 60 days for care in a facility. And guess what? Your time spent receiving home health care will satisfy the 60-day facility elimination period. There are two companies, though, that work a little bit differently. They have a 0-day elimination period. Your clients will be eligible for benefits immediately. That's Prudential and Lincoln Financial on their multi-pay ULs. And I try and think like a client here or like the client's family. If they know they have a policy and they qualify for benefits, I've got a feeling that they're not going to remember they have a 90-day elimination, that they have to pay the first 3 months out of their own pocket. All they're going to know is that they've qualified for benefits and should start receiving some money. I would rather have a client with a 0-day elimination than to have to tell him, no, look, you have to pay the first 90 days out of your own pocket. But again, you get what you pay for, too. All right, our sixth element, the benefit payment amount is what I like to call this. I've been mentioning all along that our clients can access that death benefit for LTC purposes when they need it. Well, how much can they access? That's going to differ from company to company. One company out there, Protective Life, they will offer your client a specified amount, and you type this into the illustration when you run it. And would your client want $2,000 a month, $5,000 a month, $8,000 a month? You can put in an exact dollar figure, and that's the amount of their death benefit they're going to be able to accelerate every month. Now, let's say they have $10,000 a month available to them. First of all, that a $10,000 rider is going to cost them more than a $2,000 rider. But they don't have to take the whole $10K. What if their expenses are just $5,000 a month? That's fine. They just request $5,000 rather than $10,000. Or they could take the whole $10,000 and put the other $5,000 in the bank or spend it on whatever they like. It doesn't really matter. But your client can name their exact figure there. Most of the companies out there will pay out benefits expressed as a percentage of the face amount. To give you an example, let's say you have a $100,000 policy, and most of these use 2% per month as that figure. So at 2% per month, your client's going to get $2,000 a month based on that $100,000 policy. They're going to know exactly what they're going to get because even though it's not an exact dollar figure, it's easy to figure out what that number would be. Some companies do offer 3 or even 4% per month as an option. The third way to pay out the benefits would be to determine the amount at the time of claim. These can get a little tricky if you're trying to explain it to a client. They typically cost a lot less than the other options we mentioned because you don't pay anything up front for the rider. In many cases, this benefit is just built into the product. Now, the company still has to charge a fee for that rider. They're going to do it on the back end when your client files the claim. And what they're going to do is I'll give you an example. One of the companies out there, they say in the policy that they will accelerate up to 24% of your face amount per year. Guess what? That works out to 2% per month. But since you're not paying anything for the rider up front, they're going to take that 24% figure that they would accelerate to your client, and they're going to say, okay, based on life expectancy charts, we shouldn't have to pay this amount out to your client today. Maybe we expect to pay it out in 5 years. Well, by giving that to your client today, we can't earn any interest on this money. So what interest do we expect that we could have made on this money over the next 5 years before we expect your client to die? They're going to figure out what that number is, and they're going to subtract it from that 24% figure. They're going to keep that, and they're going to give the remainder to your client. Now, unfortunately, you're never going to be able to tell your client exactly how much of that 24% they're going to get because we don't know when they're going to go on claim. We don't know what current interest rates are going to be. Really hard to explain if your client wants to know an exact number. On the flip side, though, your client isn't paying anything up front for this rider. It's coming off of their benefit. They're using the insurance company's money, essentially, to pay for the rider. And let's see here. I guess I went over some of these points here already. I'll leave this slide up for just a second here. It's a recap of what I just explained about the benefit payment amount. Okay, moving on to element number 7. We're almost to the end. I've got a total of 8 here. The benefit payment method. Companies will choose one of these 2 methods to pay out the benefit to your client, and it's probably going to be the indemnity method, but I'll mention reimbursement first. There's only a couple of carriers that will do this. This is usually found on the true LTC riders, and the policy will pay up to the actual costs of care. So that means your client is either going to have to prove their expenses by hanging on to all of their receipts, or the insurance company is going to work directly with the care provider and pay the cost of services. Now, most of the companies will use the indemnity model, and the full benefit, whatever it happens to be per month or per year, is going to be paid regardless of your client's actual expenses. Your client might receive some extra money this way, and the client can use that for whatever they want. If they want to help pay for the airfare of some relative to come in from out of state and stay with them, visit with them for a while, or help pay for hotel rooms, help pay for somebody to mow the lawn, you name it. I mean, the money is theirs. They can do whatever they want with that. It's very easy to administer from a insurance company perspective, easy from your client's perspective too. All they're going to do is receive a check, and it's up to them what they do with it then. And again, this model is usually found on those chronic illness riders that are filed under Code 101G. And our eighth element, inflation protect. This is really interesting. This is where we can get creative in our product design. Inflation protection is something that is very common on traditional long-term care policies. In fact, in some cases, your client has to sign off stating that they don't want it if they don't want to include it on there. But you'll typically see 3 or 5% simple or compound inflation being applied to the LTC benefit amount. And you know what? That is available on some of these life insurance-based solutions. Lincoln Financial's MoneyGuard and State Life's Asset Care have inflation protection available if your client is young enough. However, none of these others have it designed exactly that way. There's some ways we can mimic inflation protection, though, and I think the carriers will state you're really not supposed to call it inflation protection because it's not. But one of the things a person can do to try to mimic that is to use a per diem benefit. And back on that slide about the payment amount, I didn't mention the per diem benefit, but that's another way that the carrier can arrange to pay out the benefit to your client. Rather than set the amount as an exact dollar figure or a percentage, what they will do is pay out to your client up to the federal per diem daily LTC benefit amount, and that's something the federal government sets every year. Currently, I think it's set at $340 per day. That works out to $10,200 per month, and the figure typically increases a little bit, about 4% per year historically. So what that means is, say your client has a $500,000 benefit pool, and they have the per diem benefit amount on there. Right now, that means they can get to 10 grand a month. In 5 years, maybe they can get to 15 grand a month. In 10, 20 years, maybe they're at 20 or 25 grand a month. But their benefit pool does not change. If they start at 500, it's still going to be at 500. They can just get to more of that money every month than they could the previous year. So that's one way to sort of mimic inflation protection on one of these products. The other way to do that would be to utilize an increasing death benefit option, and we'll find this a lot on the IUL products. Maybe your client starts out with a $200,000 death benefit. They're overfunding the policy. The cash grows along with the index. And now, even though they have a 2% per month benefit, guess what? It's 2% of an increasing number. Maybe in 15, 20 years, their $200,000 death benefit is now $300,000. Thousands available for LTC purposes at 2% per month. So their monthly benefit has increased as that total pool has increased over time. So those are the 8 elements, and we'll open it up for questions here. I do want to thank everybody for joining us here this morning. If you do have some questions on this that you think of later, by all means give us a call. Our number is right there on the screen, or email me. I'm recording this webinar, so it will be available out on our YouTube channel within a few days as well. So I want to thank everybody for joining us. Let me get to the questions here.